week?
It's all about monetary policy, not only
So it's Powell on Thursday?
Powell as well as the ECB. We believe that Powell now is going on to the third unspoken mandate, which is do no harm within the financial system. And financial stress is a meaningful drag on economic activity.
Do you think Jay Powell has sort of gotten the message of not from the president, but from the markets?
All he has to do is watch the markets, because when you look at the forward-looking expectations going out a year, it looks as if that the market is pricing in an actual decrease of interest rates.
Now, I know that you've been a little more concerned about the economy than some.
Absolutely.
But and you've been right, but you also believe that we still could have positive stock market returns this year.
Yeah, I think.
Square those two.
So the best way to go about investing as a long-term investor is to look at long-term forecasted returns. And we think over the next 3 to 5 years, you can get a positive return on the S&P, roughly about 5 or 6% above the rate of inflation. Now, for this year, we think that there's going to continue to be an economic drag here in the United States, as well as global growth drag, but you could also have a positive return. You see, the Federal Reserve is going to perhaps pivot, as you saw last trading session, as well as you could also perhaps get just a moderation of economic activity here, which of course could support the market.
5 to 6% possible returns. Does that include dividends?
That does include dividends.
Because that's not a whole lot of real gain then.
Look, we're in
You're getting roughly 3% from the dividend yield. You're looking at maybe just a couple percent actual return.
That's why I've been explaining to people that you have to be more moderate with your investment ideas here. You have to be much more cautious. So you have to move up your quality spectrum, and you have to expect that you're going to have a lot more volatility within the system over the course of the next 3 years.
And I don't mean this as an insult to anybody, certainly, but a lot of people have been able to look very smart the last 7 or 8 years because we've been in this big bull market. You could pretty much throw a dart, buy an ETF, it's equity-based, make money, and feel good about yourself, which is nice. There's nothing wrong with that. But do you have to go back to picking stocks now?
I think that you should at least look to be more conservative. You can get a layer of good companies that seems of opportunities where you can make a tremendous amount of money. I look at the consumer staples side, look at healthcare, for example, and to go back on why it was so easy to make money. When the Fed had rates well below the rate of inflation for a decade, that causes free money, multiples expand and whatnot. And as you're expanding the balance sheet, it just is pure, like, it's an injection.
We had low rates and an expanded balance sheet.
It's an injection of adrenaline into the system.
Low rates, expanding balance sheet. Now we have higher rates and a contracting balance sheet.
Above the rate of inflation.
So everything good we had for 8 years has now been reversed.
It dampens the market multiple within the market.
By how much is the question? That's why, because it's already come down.
Market, I mean, now we're at forward-looking 14, 15 PE multiple. You could see 13 or 12 PE multiples. It all depends on global growth. And as you see global growth decelerate, you have to just be a little bit more cautious. What we did over the course of the last couple of trading sessions, I should say couple of weeks, we extended our duration within our bond portfolio, meaning we actually started
buying 30 years?
Buying 20-year, 30-year type investment grade.
You're the one.
Yeah, no, we're doing this. We're becoming much more cautious within our investment outlook.